Hi, it's Gina here from Will Written, and thanks very much for watching this video. Now, at Will Written, what we're here to do is to make sure that your wishes are protected. And as you probably already know from reading my blog on willwritten.com, I passionately believe that when it comes to protecting your wishes, knowledge is power. So this video is one of a series where I answer the questions that I'm most often asked by people that I meet and people who read my blog. And today I'm looking at inheritance tax. People say to me, Gina, I've worked all of my life and I've paid loads of income tax, and out of my tax earnings I've paid off my mortgage and I've put away a lovely nest egg, but that's to provide security for my other half and for my kids, and it really gets to me that out of the money that I've already paid loads of tax on already, a great big slice of my family's inheritance is going to get swallowed up in even more tax. And that tax is going to have to be paid upfront before my family even come into their inheritance. The cheek of it! Where do I stand? Is there anything that I can do about it? Well, do you know, if this is an issue that really grinds your gears, you're really not alone. People ask me about this all the time. And you know, Skipton Building Society did a survey recently that showed that 81% of us thinks that inheritance tax is totally unfair. Now, the good news is that here at Will Written, me and my team have got a range of estate plans and strategies that can make those tax problems pretty much a thing of the past. And today I'm going to give you a rough idea of where you stand, and I'm going to give you some ideas that you might want to explore. So the basic rules are these. You pay inheritance tax of 40% on everything that you own over £325,000. Well, I say everything, but that's not exactly right because some assets are actually exempt. Now, that 325,000 quid I was telling you about is called your nil rate band. And if you're married, you don't pay tax on anything that you leave together, to each other rather. And once you're both gone, your nil rate bands are added together, so that you can leave up to 650,000 quid between you before the tax kicks in if you're a married couple. Now, there are some new rules coming in that let a married couple leave a house that's worth up to £1 million to their kids without any tax. But it has to be your family home, and it has to be left directly to your children or your grandchildren. So the first thing you absolutely must do in order to manage a tax liability is make a will. A professionally drawn up will is the foundation stone of your tax planning. And one of the biggest factors that decides the size of your inheritance tax bill is who is going to inherit from you. So the wording of your will is absolutely crucial. And now for a really, really serious don't, whatever you do, sign your house over to your kids. Unless, of course, you're prepared to move out or pay your kids full market rent. It's not going to work for inheritance tax purposes unless you do that. Now, if you've got liquid cash, then you're in a great position because there's loads of brilliant investments that you can put your money into, which are specially designed to manage your inheritance tax liability. You need to talk to a financial advisor about that. But if your money's tied up in property, for example, if you're a buy-to-let investor, well, then you're going to need to work a little bit harder, I'm afraid. You can make some adjustments to the way that your properties are owned, and I can help you with that. But you need to be very careful, and you need to get legal advice and advice from accountants about the tax consequences. So anyway, let me tell you about Mr. and Mrs. Roberts, a couple that I helped recently. That's not their real name again because it's all about confidentiality in my job. Their total assets, including their house and their investments, came to £850,000. Now, if they'd done nothing, their kids would have had to pay £80,000 in tax upfront before they could come into their inheritance. So the first thing I did was shuffle their assets around a bit to make sure that they both had separate and distinct estates worth £425,000 each. Then I made protective property trust wills for them. And in those wills, each of them left £325,000 to a family trust that will come into being when they die. And that's for the benefit of each other and for their kids and grandkids. And then they each put 100,000 quid into specially designed trust funds for each other and for the family, which shielded that money from inheritance tax. And anyway, hey presto, no more inheritance tax liability, 80 grand saved. So hopefully this gives you some pointers about what you can achieve with proper planning. And I'm sure I've raised some questions. So if you do have questions, I'm here to help. Just give me a call on 0151 601 5399 or email me by clicking this link here. I hope that helps. And thanks for watching, and bye for now.